Hello and good afternoon. You're tuned in to Market Fatafat. I'm Ankita Saxena and you joined us from the Suzlon studio. And in this show, we will take you through all of that's transpiring in the market and, of course, all the stocks that are in focus. But let's get going with the show and how the market is shaping up at this point. Well, we have recovered 100 odd points from the day's lowest point on the Nifty, though we are still trading with cuts of 0.4%. We are sitting at the highest point of the day. We are above the 24,240 levels right now. As far as Nifty Bank is concerned, that has also managed a recovery from the day's lows, 295 odd points recovery from the day's lows. We are at the highest point of the day for Nifty Bank as well, but we are nonetheless trading in the red with cuts of 1%. Let's talk about the broader end of the market as well. Let's pull up the charts for mid caps. That is trading with gains of 6.7%. Now remember, it is the broader market that is really seeing a spurt of green. In fact, the mid caps is the one there where we see some momentum coming in. 6.4% gain coming in there. Small caps also trading with gains of 0.2%. Sectorally, it was the PSU banks that was taking it from the front, leading the chart from the front, and still they are trading with gains of 2%. PNB, an earnings candidate, a strong set coming in there. That one is up and away 5%. Union Bank, Bank of Baroda, in that order, are also trading with gains of 4 to 3%. Nifty Pharma is also a pack that is doing well, 1.7% gains coming right now. Torrent Pharma, Mankind, Cipla, Aurobindo, Laurus Labs, Divi's Labs, all of them are trading with gains of 2+% right now. But on the back foot are the financial services that are trading, that are declining in trade, and the Nifty Bank, the private sector banks that are seeing that dropping. Axis Bank, HDFC, Kotak, all of them again earnings candidate, which are seeing that knock in today's trading session. So that's how the market is largely shaping up at this point. We do see a recovery that we see coming all across the board, and advance decline ratio is right now tilted in the favor of advances. But let's move on and take you to an ETNOW exclusive. Sajid spoke with Krishna Chivkula, who's the Junior Whole-Time Director and CEO, and P. Balasubramanian, who's the Vice President Finance and CFO of Indo MIM, one of the world's leading manufacturers of metal injection molded components, ahead of its IPO listing this week. Now, it is a 3,700 crore IPO that comprises of 3,312 crores of offer for sale, while 400 crores will be a fresh issue to repay the borrowings. Let's go across and listen in to what the management had to say about it.
Indo MIM is essentially a contract manufacturer of high precision components for a wide range of end user markets and segments. We make components for everything from automotive, consumer electronics, medical, defense, aerospace, and energy production.
Okay, and what is the kind of this is you're making precision for them, and what kind of revenue model you have? Is it a order based thing, or is it going to be you have a long term supply agreement with many of your partners?
Yeah, it depends on the customer. Some customers, like aerospace and automotive, have long term supply agreements. You have a lot of visibility on what their demand is. But some customers, you are just a component manufacturer, you're on a specific platform, and they'll know within the year, roughly, based on their local conditions in whatever country they're in, what their demand is, and then you'll work with them, to establish that and ensure that you've got, everything in place to meet that requirement, which is basically essentially for us in MIM, things like tooling or fixturing that you need to make these components. But like I said, it depends, like aerospace and medical and all.
Bala, you're raising 500 crores in primary issuances. What is it going to be used for?
Predominantly for debt repayment to the tune of about 400 crores, and balances for GC and issue expenses.
How much is the debt you have on your books as you speak?
This will reduce about 40% of the debt that we have, or right slightly about 1,000 crores we have as debt. So 400 crores will go down because of this.
Okay. Give us a sense of the kind of margin profile that you have. I've been seeing that it's around 25% for FY26, but it has fallen off from 28% in the previous year. What is the kind of margin profile that you see in your business?
The long-term margin profile will be in line with the overall averages you have seen in the last 3 years. We can't be very specific about what number will be in future, but we feel that the business margins can be sustained in days to come.
Mr. Shivgula, can you also give us a sense of the kind of breakup of your customer base? How much of that comes from India and how much from the overseas market, and maybe a color on your the profile of the customers that you have?
Sure. I think the first thing is that we've always been focused on overseas markets. About 88 to 92% of the company's sales in any given year come from are from export markets, with the heaviest concentration being the United States and the next being the EU region. In terms of customer profiles, whatever segment we're in, we're working with the top players in that industry, regardless of whether or not it's turbochargers or firearms or aerospace or land-based gas turbines, or even things like hand tools or power tools. So we're always working with the top 4 to anywhere 10 players in the industry. With also, obviously a very, very big tail. We export to more than 45 countries around the world in any given year, and that number is always increasing to some extent. When you look at not just the components or the systems that we're going into, but the customers and the customer base and the geographies, what you see is that we're very, very well diversified, right? We're very well diversified by product segment, doing automotive, medical, defense, consumer electronics, aerospace, power generation, right? So very diversified across products, across segments, but also but even within segments, very well diversified across geography and application, right? So if you look at automotive, right, we're selling automotive components to about 30 to 40 countries around the world, across all major systems where MIM parts and investment cast parts are used, from things like turbochargers to selective catalytic reduction systems, braking systems, fuel injection systems, right? So we're well diversified across the segments, but even within segments, very well diversified across applications, and within specific applications, very well diversified across the customers and OEMs that are using that application, like regardless of whether or not it's turbochargers or braking systems or jet engines.
Bala, can you give us a sense of the kind of order book that you're sitting on at the end of FY26, and what is the typical timeline for an execution of those orders?
It depends on the segment in which we are in. Most of the metal injection molded components, we get an order book of about 2 months. Timeline for execution is also about 60 days. And as far as the aerospace components are concerned, normally you get a long-term order, long-term indication, and the delivery timeline is about 3 to 4 months. For IGT, inland gas turbine components also, you get about 3 to 4 months. Visibility for orders is much better in the gas turbine industry and aerospace industry, because the end customers also give fairly long time.
And automotive.
Automotive customers give you an indication, but generally the visibility for orders is only about 2 months.
And what is the kind of total order book that you stand at the end of FY26?
2 months sales, sir, roughly. 45 days to 2 months sales. That's what we have.
Maybe a little more.
Okay, and what do you do to ensure that you have typical continuous orders coming in? Are there enough relationships that are in place, or you have any contractual relationship which allows you to get those orders on a recurring basis?
Yeah, the nature of our business is such that we have to make molds for the customers, which are approved by the customers. So once the molds are made, the product orders will come to us only. Most of the cases where we are working with, we are the sole supplier of components for the customers. So as long as the order for the end customer is already there, definitely the order will come to us.
And then in any given year, about 90% of the revenue is from
existing customers.
Is existing orders from repeating customers. I'm sorry, repeating orders from existing customers.
All right, with that, it's time for a quick break. Don't go anywhere. After the break, we'll get you more updates on the market. Stay tuned. Welcome back. You're tuned into Market Fatafat. We're taking you through all of that transpiring on the market, and we're talking about the new kids on the block, the IPOs. Another IPO that's around the corner is Lohia Corp, one of the world's leading manufacturers of machinery for technical textiles, catering to polypropylene and high-density polyethylene woven fabrics, and it is set to hit the D Street very soon. In an ETNOW exclusive, Sajid spoke with Gaurav Lohia, who's the whole-time director, and Anupam Agarwal, who's the chief financial officer, to understand the company's growth roadmap, expansion plans, and IPO strategy. Let's listen in.
We are a machinery manufacturing company operating in the field of technical textiles, having various packaging and non-packaging applications. So some of the packaging applications where our machines are used is packaging of cement, fertilizer, chemicals, agro-produce, sugar, etc. It has various non-packaging applications as well, which goes in geotextile, logistics, tarpaulin, for example, roof underlayment, pond liner, etc. So we are a machinery manufacturing company for these sectors. We operate both in domestic sector as well as export sectors. We export to more than 100 countries worldwide, and exports contribute a substantial share to our revenue.
Okay. Mr. Agarwal, can you give us a sense of the revenue breakup in that sense? Exports is a large component which is coming in, as Mr. Lohia said. How much of exports contribute to your revenue?
So we try and balance domestic and exports. We have been doing, in the past, we have done around 60% exports also. But last year, because of West Asia related thing, the export was around 43% out of the total revenue that we did.
And on an average, how is it actually? Normally, export component is what percentage of your revenue?
So it is a balance between, it hovers around 45 to 55% every year. Since India is a dominant market, so we try and have a dominant share in the domestic market, but exports also contribute significantly every year.
Mr. Lohia, give us a sense of the kind of challenges that you have seen in the last 1 year. You had the tariff issue which came in last year, then you have the West Asia crisis which have come in. How has it impacted your business from a cost escalation point of view or from a trade point of view?
So the tariff business, the tariff thing did not impact our domestic business as such, or the Raffia machinery business as such majorly. It was only little minor hiccups. But our subsidiary in America, because of the tariff issue, faced less investment, saw less investments there in their markets of America and China. And so that was a little subdued last year. But overall, the tariff impact, and our customers were also in a wait and watch mode, but it did not impact us in a major way.
Mr. Agarwal, give us a sense of the kind of debt which is there on the books as of now for you.
So debt is around 150 odd crores. This gets naturally repaid in the next 2-3 years. This debt was taken 2-3 years back when we expanded our capacities.
Mr. Lohia, you're coming out with an OFS and you are in a segment which is growing on a fast scale. Why haven't you raised growth capital? Do you have enough capacity going forward?
So yes, we have enough capacity going forward. We are currently operating at a capacity of around 75%. And we don't envisage a major capex in the next 2 years going forward. And whatever capex requirements that we have are generally internally funded. We are a cash-generating company. And the OFS is also to give some exit to my extended family members. And there are some philanthropic objectives as well of the OFS.
Mr. Agarwal, give us a sense of your margin profile here, because for FY26 it's around 18.5. It has come, it's risen from nearly 16% in FY25. in your business, what is the kind of nominal margin that you can see?
So from a sustainability perspective, we should consider 20+% as our EBITDA margin. From financial year 25 to financial year 26, operating leverage has helped us to achieve 19.5% in financial year 26. As exports share grow in the revenue, we believe that the revenue, the operating margin will keep on inching up.
The RHP had only consolidated numbers for the last 2 years, FY 25 and 26. Is there a reason why the numbers are consolidated only for the last 2 years?
So there was a demerger that happened. Let me explain this. There was a demerger in the company that happened with effect from 1st April 24. So we have presented 1 year carved out financials from the demerged company to give a 3-year perspective to the investors.
Okay. Give us a sense of the kind of order book that you have at this point in time, given that you have 45% coming from overseas and you have remaining from domestic market. What kind of order book that you have?
Okay. So our order book at the end of March FY26 stood at something like 1,350 odd crores, and it constitutes a healthy domestic book and a substantial amount of export order book. So I think the division would be around 65 to 35. And going forward, so we see our order book maintaining its pace.
All right, let's move on to another ETNOW exclusive. The IRDAI is likely to propose a sharp reduction in commission rates on credit life insurance policies, according to the sources. My colleague Anurag Shah is joining us with more details on that.
Insurance regulator IRDAI is likely to come up with a discussion paper on distribution reforms next week, and regulator is likely to propose complete change, complete overhaul in commission structure in insurance industry. What we've been given to understand from our sources is that regulator is likely to propose a drastic cut or minimum commission in credit life insurance product. So credit life insurance products are a bundled product sold by banks or NBFCs against a loan. So if someone who has taken loan passes away, then insurance company pays the remaining loan amount to the lender. In past, we have seen mis-selling complaints were also there in credit life insurance product, and after that only RBI also proposed that there is no compulsion for a policy holder, for a customer to buy a credit life insurance policy against a loan. And regulator IRDAI is also of view that lender, which is banks or NBFCs, already earning interest on loan product, and there is no differentiation by lender on loan product which include credit life insurance and which is without credit life insurance. So regulator is of view that there should be a minimum administrative fees for selling credit life insurance policy, and which will reduce the mis-selling also. So this will have a big impact on companies like SBI Life, ICICI Pru Life, Axis Max Life Insurance Company, HDFC Life Insurance companies, because through their banca tie-up, large amount of premium is earned by these life insurance companies is through credit life insurance product, which is a bundled product sold with bank or NBFC loans.
All right, with that, it's time to pull down the curtains on this edition of Market Fatafat. I'll take your leave. Thank you so much for tuning in.